Alternative investments. These are investments that are not just your normal stock, bond, ETF. Why would you consider these? Stock market's really high. Interest rates are coming down, so CDs, bonds aren't going to pay as much interest. Stock market has some risk. We're not saying get out of stocks and bonds. This isn't investment advice. This is just showing you some alternatives for maybe a portion of your portfolio if it's applicable. Again, this is just general information, not specific investment advice. Talk to your financial advisor, read prospectuses before investing. So one option is covered calls. This is you're selling the option for someone to buy the assets you have. So some of the ETFs will have the S&P 500 or some index, and they're selling the opportunity for you to buy at different time periods at different prices. So when is this useful? Yeah, JEPI is one of the ETFs. There's a bunch of ETFs that do this. And you could do it on your own. You could hold an index and sell these options. What's the logic or the benefit? It generates income. So that produces between most of these covered calls 8 to 12% income. I think risk or the disadvantages that you'll cap the potential of the market. So if the market goes up a lot, you're going to miss out on some of that gain. That's the risk. If the market goes up a little, you'll probably do a bit better. If the market stays flat, you'll do better. Or if it goes down, you'll do better. And with interest rates on CDs or on bonds being lower, this is a way to get some income. The volatility, the standard deviation, is a little more than half of just holding the index. So if the S&P 500 standard deviation is around 16, these are around 9 in that range. So about half the volatility. So less on the upside, less on the downside. You're just earning a nice income with these. They're also most efficient to put in tax deferred accounts if taxes are an issue, depending on your situation, but that will generate a bunch of income. It's not capital gains, it's income that you'd be getting for a majority of that. Put writing, very similarly. Now, this is the opposite. You are paying for, you're receiving a payment for, you're receiving a payment for the option to buy it if it goes down. So you don't hold the index. You have to buy it if it goes down at a certain time point. So you're selling this option. Again, this is for diversification. These are all for diversification, just to have some asset class or some investment that's moving a little bit differently than the rest of your investments. If you have US stocks, foreign stocks, small company stocks, you have some bonds and fixed. This is just something else that'll benefit you in a different environment. This will be most beneficial. Yeah, WTPI is an ETF. I'm not recommending this. I'm just saying that this is an ETF that does this strategy. Generates an income, again, 8 to 12% in that range. Less volatility, similar to the call writing, that you're generating an income and you have about a little more than half the volatility of the underlying index. So you have to buy when the fund or the index that you're writing this put for drops. So if the market goes up, great, you're earning your income. If the market stays flat, great, you're earning your income, you're 8 to 12%. If the market goes down, well, if it goes down 8 to 12%, then you're flat and you'll do a little bit better if it goes down further, but there is downside risk, of course. Another option for alternatives is precious metals, gold and silver being two of them. There's platinum, palladium. There are ETFs that'll do, I think glitter is one, GLTR, that'll do a whole bunch of different precious metals. There are gold ETFs, there are silver ETFs. They hold this asset. It tends to do well in uncertainty. And when there's a lot of inflation, it'll do well. But there's risks to it. And the thing I don't like about it is it's not earning money for you. So it's not growing or it doesn't have profit involved. You're just holding an asset. So in the long run, You may be more confident in the markets growing with the economy and with inflation, whereas precious metals, it's a supply demand issue. And again, in uncertain times, they tend to move upward. And they've done well now because there's a lot of uncertainty. And they may not do as well if there becomes more certainty, of course. Bitcoin's very similar. It's not producing a product, it's not generating some kind of profit or some kind of growing with the economy. It is just an asset that's driven by supply demand. And there's all different types of cryptocurrency, Bitcoin being the most popular, I guess the most traded. You can get these in ETFs. So like gold and silver, you can hold them in your brokerage account, in your IRA, just and buy and sell them through ETFs. You don't have to hold a crypto account and deal with all that, although you can, and it's more efficient, less fees, but you can hold it through an ETF, an exchange traded fund. Preferred stock, it's a type of stock. You don't get voting rights. It generates a good dividend. Think 4 to 8%. It generates a good dividend and it doesn't have quite the volatility of a stock. You will see it move opposite interest rates, up when interest rates are dropping, down when interest rates go up. That'll influence it. And then, of course, has a correlation to the underlying stock price as well. But it's just a way for you to get a little bit more stability, a little bit more income. Hedge funds, there are a lot of ETF hedge funds, and they implement different strategies of long means you're holding it, you're buying it, just normal buying and selling. Shorting is a promise. Shorting is you make money when the index or the stock goes down. So it's the reverse of holding it and making money when it goes up. You're betting that it'll go down. And so that part doing some of the portfolio short, I know there's one hedge fund that does 75% long in defensive, low volatility stocks, and then it does 25% short in very volatile holdings. Generally, shorting, you're not doing for a long period of time. You're not long-term betting, but might. You'll hear shorts all the time, someone betting against Tesla or betting against something. But they're using that strategy to generally, it limits volatility. And there are hedge funds that'll be limited to accredited investors, but there are hedge fund exchange traded funds. So you can have access to it in your brokerage account. I think one example, QQQH, not that I'm recommending it, but there's examples. There are easily traded funds. Real estate investments with these REITs, you can get access to real estate without, you don't own the property, it's just an exchange traded fund or a mutual fund. So you buy the fund and they have a lot of different types. It can be broad US real estate throughout the US. It can be very large funds. It can be international, global, or it also can be targeting different types of real estate. It could be industrial or tech, data storage. We have seen, you can look at their portfolios, what they hold. It could be apartments. They could hold healthcare buildings. They could hold data centers or industrial real estate. Again, geographic diversification. It could be focused in one area or it could be very broad. But this is just a way of easily getting into real estate holdings. There's very low cost ETFs. In all the major ETFs, you can get Schwab, Vanguard, Fidelity, iShares. They all have ETFs that'll give you exposure to real estate. Real estate tends to be a little less volatile, not always, but a little less volatile than the stock market. And it tends to produce a nice interest, a nice dividend. So you'll get a payout that's taxed as income. And then generally you'll see volatility, but generally a bit less volatility than the market. Structured products, there's a lot of these out there, a lot of different types. One of them that's easy is a market-linked CD. And so instead of paying you an interest, instead of paying you that 4% or whatever the interest is at the time, depending on the duration, and it is buying a call option that we discussed earlier. It's buying the opportunity to have exposure to an index at maturity. So if you get a 1-year market link CD linked to the S&P 500, a lot of times at maturity, if that index is up, that S&P 500 or whatever index is up, you'll get that gain. Sometimes you get a multiple of that gain. You get 1.5 times the gain, or you get some type of multiplier with it, or just get the flat gain. And maybe it's capped. Maybe it'll be the gain up to 10% or 15% and no more. So if the market does great, a lot more, you're capped on your gains. And then on the downside with a market link CD, you'd get your money back, FDIC insured, even if the index is down. There are structured products that are linked to bonds. Sometimes on the downside, they structure it to you'll get a 10% buffer. So if at maturity in 1 year, 2 years, 3 years, whatever you decide as you want for maturity, or whatever product you select, at maturity, if it's down 10%, you get your money back. If it's down 20%, you only lose 10%. So they have a buffer in the losses. So you can have 100% cushion on the downside. You could have some buffer protection on the downside, and you can get multipliers on the upside, and you can link it to S&P 500, US small cap, foreign markets. There's a big variety of gold or other indexes that you can link it to. That can provide some exposure, but protection to the market. All right. That's it. Those were the areas I wanted to talk about, the options, they call them, puts and calls, precious metals, cryptocurrency, preferred stock, hedge funds, and the ETFs, well, and structured products. Let me know if you have any questions. Again, this is just for informational use. Definitely see an advisor if you're interested. I'm Bill Holliday with AIO Financial. We are fee-only financial planners. You can get more information about us at aiofinancial.com. We offer a free upfront meeting. You can connect. You can, right on our website, you can set up a meeting. We'd be glad to talk to you. All right, take care. That's it.